Hey everyone, I'm Professor Stefan, and in this video, we are going to talk about cold, hard cash. Whew. You know, it gets a little hot in here under these lights sometimes. Let's get started. So cash is going to be our most liquid of assets, right? It is usually the line we see at the top of the balance sheet because it is ready to pay our obligations. Now this could come in the form of things like petty cash. It could be checkings and savings accounts. It could be money orders. It could be checks. It could be different types of currencies. So cash encompasses quite a bit of different things beyond just, paper cash. Now, there's a second part to cash because what you're usually going to see on the balance sheets is a cash and cash equivalence line. So there is something equivalent to cash that kind of gets lumped together with it. Now, cash equivalents include things like T-bills, commercial paper, or money market funds. And these are basically very short-term investments. And the investments where you put those, they have really short turnover. And so there's very little risk of kind of interest rate changes or losses. And so because these things can be converted to cash so quickly, we're usually going to lump them together with our cash balance and report that as one line on cash and cash equivalents. Now, in terms of reporting cash and cash equivalents, as I mentioned, this is going to get one line on the balance sheet and usually go right at the top because it is so liquid. It is going to be reconciled by the cash flow statement. So how our cash balance changed from one year to the next gets explained in that cash flow statement, as we've previously learned. And there's going to be a footnote disclosure kind of explaining what those cash equivalents are. So an investor or a lender can understand kind of where are we putting our short-term investments, what kind of risk might those things actually be at. And there is a potential, maybe you guys have run into this occasionally, that cash could go negative, right? If we overdraft a checking account, that would look like a negative cash balance. And the way GAAP deals with that is saying like, look, if you overdraft a checking account, you owe that bank some money. And so you're never going to see a negative cash balance on the balance sheet, but if that happens, it would get reported as a short-term liability. Now, there are two things we need to be aware about with reporting cash. We sometimes see restricted cash and we sometimes see compensating balances. So we're going to take a minute to go over these. Now, restricted cash could come in a few different varieties. It could be cash held in some sort of escrow account. It could be cash set aside for payroll liabilities or workers' comp liabilities. It could be cash set aside for a bond sinking fund. So if you need a big pile of cash to pay off your bonds, you might start setting that aside early on. And in reporting terms, if this restricted cash is going to be used up within 1 year, we will report that as a current asset. But if we're going to use it up more than 1 year out, we'll report that as a non-current asset. So kind of consistent with what we've seen from other assets on our balance sheet. So we can see from Whole Foods' balance sheet here, they report restricted cash, and it actually falls below both the cash and cash equivalents line and the short-term investments line because this is less liquid than those. So it's harder to kind of get to this cash and use it up. And in the footnote disclosure, they describe that this restricted cash is for some projected workers' compensation obligations, and it is for some rent guarantees on some of their operating leases. Now, compensating balances are a little bit different. This is where the company takes out a loan or they borrow money from, say, a bank, and that bank requires them to keep some amount of cash on hand with that lending institution. So for instance, if I borrow $1 million and the bank says, okay, I'll give you $1 million, but you need to keep at least 100,000 of that in the checking account with us, that would be considered a compensating balance. Now, if this is a legally binding agreement, so this compensating balance is written out in the debt contract, then it would get reported separately under current or non-current assets, depending on kind of whether the liability is a current liability or a non-current liability. Now, if this is just an informal agreement, so it is not legally binding, then it would potentially just get disclosed in the footnotes, but otherwise that cash balance would be reported with cash and cash equivalents. So let's think about why a bank might require a compensating balance, because it seems like kind of a weird idea. And you could look at kind of two almost equivalent scenarios. One where I borrow $1 million, but I have to keep a $100,000 compensating balance in the checking account with the bank. That basically leaves me $900,000 to, do what I will with my business. Or I could just borrow $900,000 and have no compensating balance in the bank. So kind of why would we have these two different scenarios? Why might we pick the compensating balance scenario over the other one? Because otherwise they seem fairly equivalent, right? So suppose we have Bruce Bank and they loan Marlin Company $1 million at an 8% annual rate, but they require 10% of that loan amount to be kept on hand as a compensating balance at Bruce Bank. And so what we want to see is, well, how does this change the interest rate of the loan, right? So I'm going to pay $80,000 of interest on this $1 million loan, right? But I only get to really use $900,000 of this loan, this $1 million loan that I'm giving, because I have to leave $100,000 in the bank. So effectively, I only get the benefit of borrowing $900,000. And so if I'm paying $80,000 on what is effectively for me a $900,000 loan, then my effective interest rate jumps up to almost 8.9%. So what this does is raise the effective interest rate for the borrowing company. Now, why the borrowing company would still do this compensating balance arrangement versus borrowing less money at a higher rate, who knows? But this is fairly common to kind of require these balances on hand from lending institutions. So, closing thoughts here. Our cash and cash equivalents, so things that aren't quite cash but are very, very short-term maturities, get reported together on the balance sheet. We have restricted cash, which is going to be reported separately, and there's a handful of different scenarios why a firm might have legally restricted cash, and they'll disclose in the footnotes kind of why that cash is restricted and what it is going to be used for. And then we have compensating balance arrangements that are related to loans, where a company has to keep some balance of cash on hand at that bank, and it effectively raises the interest rate for the borrowing company. Thanks for watching.